Today, we're diving into a real financial head-scratcher. Imagine this. An investor puts a big chunk of money into what's called a conservative retirement account, the supposedly safe option. They don't touch it for more than a decade that saw a huge stock market boom. But when they go to check the balance, a massive piece of their nest egg has just vanished. Let's crack this case. All right, let's look at the hard evidence. The account kicks off with $60,000 back in 2014. Fast forward 12 years, and it's sitting at just $39,000. That's a $21,000 loss. We're talking more than a third of the entire initial investment gone. And remember, this wasn't during some epic market crash, so seriously, where did the money go? This is the absolute heart of the mystery, right? The word conservative is supposed to mean safety. It's supposed to mean you're preserving your capital, maybe getting a little bit of modest growth. It most definitely does not mean losing 35% of your money. It just makes no sense. So let's start lining up our suspects. Our first and, let's be honest, most common suspect in these cases is always the fees. I mean, every investment fund charges you something for their services, but sometimes those fees are so outrageously high, they act like a constant parasite, just slowly bleeding your account dry year after year. Let's take a look under the hood of this fund. The key piece of evidence we're looking for here is called the expense ratio, or ER for short. Think of it as the fund's annual price tag. It's the percentage of your money that the company takes every single year, whether your investment goes up or down. A low ER is great. A high one can absolutely destroy your returns over the long haul. And, whoa, here we go. Here is our first major clue. The expense ratio for this John Hancock fund is 1.23%. Now, just to give you some context, you can find great, low-cost index funds that charge less than 0.1%. An expense ratio over 1% is what a lot of financial experts would call, well, basically highway robbery. This is a massive, massive red flag. Okay, so the fees are terrible, but maybe, just maybe, those high fees were paying for some genius fund managers who were knocking it out of the park with incredible returns. I mean, it's pretty rare, but it could happen. So that brings us to our second suspect. Good old-fashioned poor performance. Was this fund just a dud? And well, the numbers speak for themselves, don't they? We put this fund up against a similar conservative fund from another company, and just look at this. In 1 year, our mystery fund barely made 2%, while the competitor pulled in almost 15%. Over 10 years, it limped along at about 4% a year, while the other fund was clearing over 7%. The evidence is pretty overwhelming. This fund was a chronic underperformer. So now we've got two pretty clear culprits: sky-high fees and just terrible performance. But here's the twist in our story. Even when you run the numbers on both of those things combined, losing 21 grand on a $60,000 investment, it still seems like way too much. The math just isn't mathing. Something else is going on here. Now, the family who was looking into this account was absolutely positive that no money had been taken out. They looked at the account online, and all they saw was this sad, slow, downward slope on the graph. They scoured the statements looking for the word withdrawal, and nothing. So it seemed like the most obvious explanation was off the table. But hiding in plain sight on those very same statements was a phrase that kept popping up. A classic piece of confusing financial jargon that actually held the key to this entire case: normal distribution. What in the world is that? Is it a dividend? Some kind of weird accounting thing? Well, that confusion is probably intentional, and it's where we find our answer. And there it is, the smoking gun. In the bizarre language of traditional IRAs, a normal distribution is the official and, let's be real, deliberately confusing term for a withdrawal. It's just money being taken out of the account. The money wasn't just disappearing into thin air because of bad performance. It was being actively taken out. As soon as you know the code, the whole case cracks wide open. A closer look at the statements revealed the truth. Over just 3 years, a total of $31,000 was taken out in these so-called normal distributions. And that completely explains the massive drop in the account's value. The case of the disappearing money is solved. It wasn't some phantom financial black hole. It was a series of real withdrawals, just hidden behind confusing language. But wait, solving the main mystery doesn't mean the case is closed. Not at all. Because even if you ignore those withdrawals, this was an absolutely terrible place to keep your money. The killer combination of high fees and poor performance was still a guaranteed recipe for losing wealth over time. So, solving one crime just ended up revealing another one. This was simply a bad investment, period. So, how can you avoid a trap like this? Well, you have to become your own financial detective. It's not as hard as it sounds. Step 1, read every single line of your statements. Every one. Step 2, if you see a term you don't recognize, Google it, or better yet, call your provider and make them explain it in plain English. Step 3, always compare your fund's fees and performance against its competitors. And finally, step 4, for most of us, the best bet is to just keep it simple. Low-cost, diversified index funds are often the way to go. And here's one last really crucial lesson from this whole affair. Don't fall for the conservative fund trap. That word conservative is a marketing term. It is not a guarantee of anything. These funds are usually full of bonds. And here's the thing about bonds. If you own a bond that pays you 3%, and then the new bonds start paying 5%, your old 3% bond suddenly looks a lot less attractive, and its value can actually go down. So even in a bond fund, your initial investment isn't always 100% safe. Ultimately, this whole case wasn't about some elaborate scam. It was about something much more common: the critical importance of simply paying attention and really understanding what it is you own. Your retirement is the single most important financial case you will ever work on. The only question is, are you investigating all the clues